Something really exciting is happening in Pakistan's financial world. We're seeing more and more people jumping into investing, and what's really cool is the growing number of women getting involved. But for a lot of these new investors, this exciting journey hits a huge wall right at the very beginning.
So, what is this wall?
Well, it's this one single super demotivating factor that can stop your investment journey dead in its tracks. It's that gut-wrenching feeling of losing money the moment you put it in.
Okay, picture this. You've saved up, you're ready to go, and you invest 1 lakh rupees. But on the very first day, before the market has even had a chance to move an inch, you look at your account and you're already down 2 or even 3,000 rupees. This immediate loss comes from something called a front-end load, which a lot of mutual funds charge you. I mean, talk about a discouraging way to start, right? So this initial fee, this front-end load, that's the core problem we're going to tackle today. It's a hidden cost that just eats away at your capital right from the get-go. But what if there was a way to just avoid it entirely?
Well, there is a better path, and it's available to you right on the Pakistan Stock Exchange. The solution is something called an exchange-traded fund, or ETF for short. And believe me, this alternative completely changes the game for new investors.
ETFs have two huge advantages that directly solve this problem. First, and most importantly, there is absolutely zero front-end load. Every single rupee you invest goes to work for you from day one. And second, ETFs let you build a diversified portfolio of top companies with just a single click, pretty much like buying a single share of stock.
And listen, this isn't some brand new, untested idea. The whole journey began way back in 1975 in the US with the very first low-cost index fund. After literally exploding in global popularity, this powerful investment tool finally launched right here in Pakistan in 2020. Okay, so now we know what ETFs are and why they're so great. Let's get practical. How do you actually go about choosing one? We're going to walk through a super simple framework you can use to evaluate the top options available in Pakistan today. It's really as easy as 1, 2, 3. You can judge any ETF on these 3 simple criteria. First, what companies does it actually hold in its portfolio? Second, how liquid is it? And don't worry, we'll explain exactly what that means in a second. And third, what are the annual fees? Let's zoom in on that second point, liquidity. This is a really critical concept, especially in the Pakistani market. To put it simply, liquidity is just how easily you can sell your investment and get your cash back quickly and at a fair price.
This slide just illustrates the concept perfectly. Think about selling a house. That's what we'd call an illiquid asset. It can take months to find a buyer, right? It's a whole process. Now, think about a really popular stock. That's a liquid asset. You can sell it, boom, instantly at the market price. The challenge is, in Pakistan, some ETFs still behave a little more like a house than a stock.
All right, let's dive into our first option, the UBL Pakistan Enterprise ETF. This one's considered a blue chip index, which basically means it holds 9 of Pakistan's biggest, most stable companies. As you can see, it's pretty heavily weighted towards foundational sectors like fertilizer, with Faji Fertilizer, and banking, with UBL. Now, it's really important to note that it has zero exposure to the oil and gas sector, which could be a good or a bad thing depending on your personal outlook. You get stability, but you might miss out if there's a big rally in energy prices. The annual fee is a very competitive 1%. Next up is the Meezan ETF. This is a very popular sharia-compliant option that tracks the KMI 30 index. It holds 12 different Pakistani companies with a strong focus on industrial sectors. Think fertilizer, power generation, cement, basically the building blocks of the economy. And its daily trading volume is pretty decent, which makes it fairly liquid for us retail investors who are looking to buy or sell. The annual fee here is also right around that 1% mark. And finally, if you're looking for maximum diversification, the Mahana Islamic Index ETF is a real standout. It holds 30 different sharia-compliant companies, so it gives you the absolute broadest exposure to the market in just a single investment. And even though it's newer, it has quickly become Pakistan's largest ETF by fund size, which really speaks to its popularity and how much investors trust it. And yep, it also has that same competitive 1% annual fee. So we've talked about a 1% fee for an ETF versus, say, a 4% total fee for a mutual fund. I know, a 3% difference doesn't sound like a lot, does it? But I'm telling you, over the long term, this small number has a wealth-shattering impact. This is the part that truly, truly matters for your financial future. Hey, and you don't have to just take my word for it.
Warren Buffett, probably the greatest investor of all time, has said again and again that for most people, the best strategy is just to own a broad, low-cost index fund. As he puts it, cost is king. All right, brace yourself because these numbers are absolutely jaw-dropping. Let's assume you invest 1 lakh rupees and the market gives you its historical average return of 18% per year. With a mutual fund charging 4% in total fees, your actual net return is 14%. After 25 years, you have about 2.6 million rupees. Not bad. But with an ETF charging just 1%, your net return is 17%. After those same 25 years, you have over 5 million rupees.
Just let that sink in visually for a moment. It's the same investment, the same market, the same amount of time. The only major difference is the fee. That seemingly tiny 3% difference costs the investor nearly half of their potential wealth. The ETF portfolio is worth almost double. This is the devastating power of fees over time.
So what's the final verdict here? Are ETFs the perfect, magical solution for every single investor in Pakistan? Well, not quite. There are a couple of really important nuances we need to consider before we wrap up. Remember our little chat about liquidity? This is where it comes back to bite us. Because liquidity for ETFs in Pakistan is still, developing, there can be a pretty wide bid-ask spread. All this means is that the price to buy an ETF might be 101 rupees, but the price to sell it at the exact same moment is only 99 rupees. That 2 rupee gap is another small hidden transaction cost that you just have to be aware of. So let's put it all together. Here's the verdict. ETFs in Pakistan are an absolutely excellent choice for retail investors, especially if you're investing up to around 1 lakh rupees, where that liquidity stuff isn't a huge issue. And of course, this is only true if you've actually looked at the portfolio and you're happy to own the basket of companies inside that specific ETF. We've seen how a few little percentage points in fees can literally mean millions of rupees over a lifetime. It's such a powerful lesson that these small, hidden costs can have absolutely massive consequences down the road. So the real question I want to leave you with is this. After seeing these numbers, how will you invest differently to protect your future wealth?